Hey, everybody, welcome back. And mortgage rates are starting to calm down. Buyers are definitely coming back into the market after, we had some, I guess more spiked up rates and then it came back down. We're going to go into that a little bit more. Hang on. Okay, so a lot of folks have been saying, George, what the heck is going on? Well, that's a great question because the mortgage rates, probably one of the biggest drivers of buyer activity in the market next to inventory levels, has been, it's been a little erratic. And in fact, when we take a look at the lowest mortgage rates in nearly 3 weeks, people are like, whoa, wait a second. What are you talking about? Well, actually, so when we take a look at the Feds, I said, look, 30-year mortgage rates have fluctuated less than 20 basis points. That's just less than a quarter of a point, or 0.2%. Okay. Stability continues to bode well for buyers and sellers. And the funny thing is, when you take a look at the 30-year, we're at 6.81% today. And then, of course, a year ago, we were at 7.17. Now, I get it. This last week, we spiked up. We came back down. We went back up. And we're coming back down again. And in fact, we left Friday on a very positive note. But it's only been about 0.25% rate shift. Actually, it's been less than that, right? 0.2. Now, I'm not saying that that's not a lot, because in our price point, when we look at median price points, like in Seattle, around 800,000. We look on the east side, maybe 920,000. That quarter of a point, or 0.2%, that adds up. And I get that, right? However, the nice thing is it's been very stable, all things considered. Yes, the Feds did nothing different other than say, no, we're not going to change anything, even though there was some pressure by the administration. However, they're staying the course, as they should right now, although I do anticipate probably 0.25% rate drops between, I would say, July and the end of the year-ish. I've been getting a lot of questions. Hey, George, are we going to see rates down in the 4s or the 3s? No, you're not. The Feds artificially brought that down by buying mortgage-backed securities. I don't see that happening. Right now, the economy, all things considered, is doing really well. In fact, when we take a look at we take a look at our news articles. Mortgage applications dropped sharply in response to the recent rate spike. Yeah, no kidding there. New home sales running near highest pace since 2022. We're going to get into that a little bit. And then mortgage rates pulled in two directions. And that basically they're going back and forth. And you can see the upper right-hand corner chart. You can see the daily activity goes up and down and up and down, because, again, it's based on yields, right? They're mortgage-backed securities. Follow the 10-year treasury. You're going to see how they just freakishly follow each other, although they're not tied to together. But mortgage-backed securities, look at your bonds. When the bonds do really well, mortgage rates come down. When the bonds do really well, 10-year treasuries come down, because the two fight for the same dollar, just keeping it in the simplified form. So as we move forward, and we start taking a look at what Freddie has to say for our running 7-day average. Look at that, 6.81. More importantly, we're down 0.02, I should say, from where we were at last week. And of course, we're down a little over a third over year. And that's super important, because that translates into what buyers and sellers are doing. So even though we were at 1.5 months last year at this time, actually 1.7, we had about a half a month increase in inventory. A lot of that is seasonal, okay? And when we talk about seasonal, it is normal for spring inventory to go up. And I'll show you that in a chart here momentarily. But our inventory has been on the way down, because we're seeing some really good activity. However, here's the funny thing. If we blow up our running day, 7-day average, look at this. Yesterday, again, just absolutely blew it up. Yes, we're one of the contributors there. 1,245 homes coming on market, seasonally normal. Still 1,054. So they're holding their course. Some people are saying, oh my gosh, George, are we slowing down, or is the market shifting, or are we heading to a crash? No, we're not. We are doing exactly as expected. It is seasonally normal to see this kind of activity, to see this thing kind of blossom up. If I blow this chart up and you look at this, and we can see where we see the spikes, and as the inventory continues to increase. Those are last year's numbers even. So as we continue to see that, what we will call seasonally normal activity as far as new homes coming on market, buyers becoming more active because rates are, well, all things considered, staying the course. That is normal for our overall summer activity to increase. However, we have the vacation trifecta. So we're coming up into May here. Let's see, getting to the end of April. So about May 15th, home buyers, they take that I'm looking for a home hat off. And we've got, Memorial Day weekend coming up. So that week of May, which would be the last week of May, buyers are thinking about other things, weather's super nice, birds, critters out doing their thing, and so do people. They go out, they enjoy life, 3-day weekend. Then all of a sudden, we have students getting out of college, students getting out of school. We have transitioning families. And if not, we still have people that are transitioning into the summer, I want to go out and spend some time. Oh my gosh, I get to break out of my house. It's going to be sunny, warm weather. And away they go, right? Then we have 4th of July weekend. Okay, again, that at the end of June, first week in July, buyer brains are elsewhere. But that changes. The week after people get back from the July 4th long weekend, we will see a spike of activity, summer activity, until about mid-August. So for sellers out there, make sure you understand your timing, because from about the middle of May until the 4th of July weekend, we call that the real estate ghost town, or what I like to say, the vacation trifecta for buyers. And it is seasonally normal. We will see again this year. And in fact, the last few years, although 2024 really kind of sucked for a real estate market in a lot of different ways, the 2020, 2021, and 2022, those were the anomalous years. Those are the years because we had such low inventory. We were supposed to stay home, different things happening. We're going to get back to situation normal. We saw part of that in 2024. So seasonally normal. Now, as we kind of pop over and we take a look at what are the real metrics. All right. So we've seen a pretty healthy bump in activity when we call to, new or homes available for sale. Yeah, it's up about 39-40%. That is normal. We had a little bit lower last year. We're still below seasonal normals, but we're still there. When we take a look at just the month of April, year over year, we're up about 3,300 homes. That gives you an indicator that we are seeing more sellers come to life. And what's funny is it's only about 500 more homes than what we saw last year at this time. But look, our solds and our pending, both on the year to date, the upper chart and the lower chart, and our pended, okay, that's where a buyer and seller agree on terms, are still up. And our numbers are still being consistent. We're still looking at great numbers and normal numbers as we move forward. Look, we went from 1.7 to about 2.2 months of inventory. All right. Sure. We have about a half a month increase, which was absolutely necessary. Why? Well, because when we take a look at new construction has been battling it out. And we have just where we were all green, positive numbers, on excluding only looking at, resales and whatnot. Then we come here and we only look at new construction. Look, our numbers are down, and not unexpected at all. In fact, if we blow up the chart, we're down just a little bit on, year over year, newer homes coming on market. Not a whole lot, just a few hundred homes. Then we talk about our solds. Solds are down just a little bit. Again, not a whole lot. When we take a look at pended's down a little bit more, and a lot of that is because we're seeing the resales coming in at a higher level, which puts a lot of pressure on the builders. They have to be a little bit more creative, and they are being a little more creative. And in fact, we are seeing a little bit of adjustment in price, which we normally don't see. So there's a big incentive. But look, a lot of new construction, they get that premium because, well, it's new construction. So they get that 8 to 10% premium above resales. However, they're typically in areas or much smaller lots than people are looking for, because as we get our return to work, people want a little bit more space around them. Boop, they will actually look at a resale versus new construction because there's more options. It's perfect sense, right? All right. So as we come back and we take a look at what is happening on the other side, which is our bank-owned again, super limited inventory. Again, just not a whole lot of inventory in the core area there. And when we pop this up, listen, we only have 73 homes across the entire Northwest MLS. And that's peanuts. Our sales are up because we're seeing some adjustment on pricing, which is exactly what they needed to do because they were overpriced anyway. So when we talk about on the overall health of our market, how are we doing? I would say that we are in the 80% or better as far as looking at things nationwide. We are, and always have been, very, I would say, separate. We're very distinct in our market. We have a lot of demographics that help to fit in, as far as income and business demographics, which gives us a lot of stability. We're one of the top 5 real estate markets across the United States. And as you saw from our numbers, we're doing really well. I know there's a lot of information out there that they talk about on the national level. On our side, I still think we're going to see a 4 to 6% appreciation. I did bring it down a little bit just because we're not seeing the rates come down as aggressively as we had hoped. I was hoping to be below 6.5% at this point in time. Realistically, I think we are going to see that more towards the end of the year. There's just a lot of blowback on some of the administration, a lot of things that are going on, a lot of changes. And when people find that there's so much noise, so much uncertainty, that they tend to pull back a little bit. And that also happens with bonds and investors. And so that means our rates aren't quite where they could be, but I think that they will be in time. So with that, if you have any questions, let us know. Hope you have an absolutely beautiful day out there. In the meantime, I will see you guys on the next video. Take care.